All right, I know we are about a minute over, so let's get started. And I think some other folks will be signing in as we go here. This is being recorded, and we will make the recording available. Share that with folks after the fact. But yeah, we're going to try to keep this under an hour here. We're going to cover a lot of information, move quickly. So first, thanks again for joining us. This is session number 2 of our annual monthly workshop series. My name is Jason Dahl. I'm a certified financial planner, the director of financial planning services, and a partner at AFS Financial Group. And with me is my colleague, Al Badabek, the founder and managing partner of AFS. And I know we have folks who tune in from our 401k team, for the 401k side of our business. So it's just as a quick reminder, we at AFS Financial Group operate as a separate entity from the AFS 401k retirement services team, but we do often collaborate, especially when it comes to our financial wellness programs and workshops such as this. Today, we will be discussing buying, renting, and refinancing in 2022. And the current housing market definitely feels unprecedented in many respects, making buying a house or second property an even more daunting endeavor than usual. In today's session, we will dive deeper into what's going on and lead you through the most important and often overlooked nuances of the home ownership process. And the materials we'll cover in this session are great for those looking to refinance while interest rates are still low, those considering a second property or vacation home, and any first-time home buyers. As a quick reminder, please feel free to ask questions at any time during the session. You can ask a question by typing them in the Q&A link on your screen. We will keep everyone on mute. But I want to encourage you to please directly follow up with us after the webinar, or if you're listening to the recording, please feel free to reach out to us if you have additional questions related to today's session or anything else. We truly do love what we do, and one of the best parts of what we do is connecting with people and helping you solve personal financial planning puzzles, so please don't hesitate to reach out. Also, just a quick note on the recording that there is time, time sensitive, time data and stats on here. So if you are listening to this recording sometime in the future, please make note of that, that these are statistics and things that are up to date as of this recording. All right. So thinking about home ownership and the American dream, I think those two things are often closely tied together. I think here in America, we're often conditioned to buy a house, right? And there is no doubt that home ownership does come with a lot of benefits, right? Like whether that be, the tax code, right? There are tax benefits from home ownership in particular, right? Mortgage interest write-off. We'll talk a little bit more about that and some of the recent changes on that front, right? But there are a lot of other benefits, whether it be on kind of the softer side of things, right? Having a place to call your own, and all the positive feelings that come from that, as well as appreciation, right? Home ownership has definitely been an area where people have built wealth over many years in this country. But like anything, it isn't always a sure thing. and we'll sort of talk about some of the cautionary items of home ownership as well, whether it be a primary residence, second home, vacation home, and so forth. One of the points that I always kind of like to mention when you're thinking about buying a house, for any purpose, is kind of having some clarity, sort of going into it eyes wide open, and sort of the distinction between am I buying this primarily as an investment, or am I buying this primarily as a quote unquote dream home, right? Whether that dream home is, for my primary residence or my dream kind of vacation home, right? And sometimes those lines can get blurred, right? You might say, hey, especially when you're thinking about a second home, you may say, hey, this is something, that I want to use personally and enjoy it, but also rent it out, right? But I think it's important to sort of prioritize, okay, because then that can sort of help you think about it analytically, right? And think about the financial side of it, right? So if this is primarily an investment purchase, that will really sort of play into the calculations around, the costs, the revenue, and so forth. I know for myself, my wife and I bought our house in 2008, and our initial plan was this is primarily an investment. It was a duplex with the ability to finish out a basement for potentially a third unit, and we were thinking of it as, hey, you know what, let's get this turned into 3 rental units potentially. And so we went into that really thinking about it as an investment. All of the sort of the financial components of it, or we thought of it that way. We did live in it for a while. We still live in it because it is now kind of evolved into our quote unquote dream house, if you will. So we continue to rent out a portion of it, but we're getting ready to kind of do some renovations, and because it's turned out that we really like the location. It's close to the kids' schools and all those sorts of good things. But I know it really helped us initially having that sort of clarity up front. Sort of why were we buying this particular property? Renting versus buying, right? Sort of the flip side of the American dream, right? And that conditioning of always buying is that, oh, well, money spent on rent is just sort of wasted, right? Flushing it down the toilet, we oftentimes hear. And while that's typically tied to you're not building equity, right? Like when you're buying a home and you're making that mortgage payment, you hopefully you're building equity in an appreciating asset when you buy a home. And rent, you're not doing that. But that's not to say that renting is always bad, right? And we've now seen a lot of sort of folks at the tail end of their careers and transitioning into retirement going the renting route, where maybe not as much as in years past, or at least from our perspective, right? Some folks are just saying, I don't want to deal with the house, right? I want to downsize. I don't want to deal with the big yard and all the maintenance that comes with that, and the maintenance of a house and the utility bills that come with a big house, and right. And some folks just like the idea of renting and just locking the door and leaving when they want to go on vacation. And when something needs fixed, they just call the landlord, right? And so there's definitely some pros to that. And from a financial perspective, we often talk about right, when buying, typically, right, you have some set of your expenses are fixed, right? You have that mortgage and the principal and interest component of it, right? And most people do a 30-year mortgage. That number, what it's going to be, versus renting, right? You may know what it is for the term of your lease, but when it comes time to renew that lease, it could go up on you, right? And we're going to show some slides that illustrate some of the recent increases in rent, right? And so that's something to consider. The flip side of that is with renting, all those sort of maintenance costs you don't have to worry about, right? Or real estate taxes you don't have to worry about, right? So that's a little bit more of a fixed known commodity versus when you own a home. And depending on, and Alp and I are going to talk about, right, that can vary between if you're owning a condo or you have a townhouse or a single family home. But right, the maintenance costs could potentially be vary widely depending on the kind of home that you buy.
And never ending.
And never ending. That's absolutely the case. I remember when we first bought our house, my mother-in-law made the comment, and I thought, wow, this is so true. A house will take all the money you're willing to give it. And if you've never seen the movie The Money Pit, I definitely recommend you watch it. It's a good, funny movie, but it can also leave a pit in your stomach too if you've ever experienced that. Buy a house and just, wow, what's behind this wall, right? And you discover all the kind of deferred maintenance things that may have been hidden in buying the house. So how do you know when you're ready to buy, right? And primarily we think about this from the perspective of a first-time home buyer, right? Like somebody who is making that first leap into home ownership. And obviously credit score is a huge piece of that puzzle. We have an entirely a separate workshop where we dive into all the depths of a credit score, so we're not really going to get into that here. Just a quick sidebar, a lot of topics in today's presentation. We have sub workshops and blog posts and things that we've written. So we are going to scratch the surface just on a few of these things, but there's definitely more info that we can provide. Right. So credit score is obviously a key one, right? If you're going to be getting a mortgage, most folks get a mortgage, right? Someone's going to lend you money. They want to know what your credit history looks like, your credit score. Closely related to that is your income, right? How steady is it? How long have you had income? Obviously, if anybody has tried to buy a house and you're self-employed and you have fluctuating income, that can be a challenge, right? The lenders really want you to provide a lot more detail as to, okay, how because they want, from their perspective, they want to see steady longevity in that income. But also just, right, from your own sort of personal financial planning perspective, you want to feel confident and comfortable that your job and your income is steady, right? Because you don't want to buy a house and then have your life really sort of turned upside down if for some reason your income is lost or reduced, right? And you've got this commitment to a mortgage, right? So that obviously a big piece of that, and that it's the same sort of logic applies to buying a second home, right? Like, so now, am I now going to be responsible for 2 mortgages, 2 sets of utility bills, 2 sets of maintenance costs, right? All those sorts of things. So that's definitely something I know we talk to clients about a lot, right? Just sort of thinking about, okay, am I comfortable with the affordability of 2 homes, and do I need to potentially rent it out, and that sort of thing.
Sure. And I think one thing that also adds to the equation is just trying to buy a house that you can live in for 5 to 10 years. So trying to avoid just a starter home for the sake of just buying a property. Sometimes we see people purchase a property and they think 3 years later they're going to buy another property. There's a lot of transaction costs, especially in Maryland, DC, and Virginia, to buy and sell a house. And so I'd prefer somebody rents until they get to a home they think they can hold on to for 5 or 10 years.
Yeah, we definitely, I know, was on a call with someone yesterday, right? Who's sort of that, what we call kind of that starter home, and sometimes we caution against the quote unquote starter home, especially if it's maybe like a smaller condo, right? And the kind of the appreciation potential on the kind of the 1-bedroom condos is limited, right? There's greater supply of that. There's less demand for those kinds of houses, and right, to Alp's point, we talk about this here on an upcoming slide, right? That how long do you plan to be in the home is certainly relevant, because you don't want to go through all the closing costs multiple times over a short period of time. But yeah, we oftentimes will caution against sort of that smaller sort of starter home if you're sort of thinking of it, this is just temporary until I can get into a more desirable home. Well, we might say rent a little bit longer, continue to save, build up the savings for the down payment, so that you can that first purchase be more of that substantive home, I'll say. If anybody's ever tuned into any of our other presentations, you've probably seen this hierarchy of financial needs that we have built. But this is really just kind of the groundwork, right? The foundation to know when you're ready to buy a home. And this is bottom up, right? And you kind of want to work your way up until you get to what we call the goal-based savings, right? But it's pretty basic stuff in some respects, right? Like, but that really applies to everybody, right? All of us are somewhere on this hierarchy, right? But building up emergency savings, right? The core sort of safety net there. HSA stands for Health Savings Account, if that's a part of your financial life. Making sure you're capturing a full retirement match for your retirement plan, paying down, paying off high interest debt, right? These are all things that you want to have accomplished and sort of checked off before you sort of commit to a mortgage, right? And buying a home. And it might seem like, wow, that's a long way up the hierarchy. But again, these truly are kind of the essential foundational pieces that you want to have in place, right? And you'll notice that before goal-based savings is making sure you're on track for retirement, right? And had this conversation, a lot with folks to really prioritize, not just the match, right? And sort of that to us is the bare minimum, but making sure that you're putting away enough to be on track to make work optional, which is the term we love to use, right, before you then sort of commit to that house, right? And recognizing that a house and the equity of a house can potentially help help fund a retirement someday. But we definitely recognize that the priority first is that retirement savings, then that goal-based savings, right? Building up the money to be able to put the 20% down payment, preferably. Another just kind of rule of thumb, I know a lot of folks kind of find this helpful, just sort of thinking about budget, right? And how much to budget for housing. All right, so there in the top line, we've got housing and utilities, right? That includes a mortgage payment, because you'll see down below we have a separate line for debt payment. That debt payment is kind of for all other debts, right? Whether it be credit card debt, student loan debt, car payment. Again, it's sort of a if you have credit card debt, generally speaking, that needs to be paid off before you get serious about buying a home, right? That's there's sort of a clear line there. Student debt, car loan, not as essential, right? It'd be, you want to make sure to get those paid down, but housing and utilities, kind of that 20 to 40% range. In this area, housing is more expensive than kind of the national average. So a lot of folks will skew closer to the 40%, right, when it comes to their total housing costs. That emergency savings piece, right? That's where you need to have kind of that maintenance cost, right? Because like Alp said, every year the house requires maintenance, right? Some years it's minimal, some years it's big, right? It could be replacing a roof or windows, right? Or the mechanical system in the house, right? And so you've got to be disciplined and make sure that you've got that money, built up and saved. So that you're not having to tap into retirement accounts, for example, to pay for those kinds of expenses. We touched on this a little bit, kind of a rule of thumb on owning a home. We like to say that you've got a solid plan and expectation that you're going to own the home for at least 7 years. That's kind of like the break even for when you sort of factor in all those closing costs, right? The costs associated with buying and selling a home, right? And I want to emphasize here the how long do you plan to own, which for some properties may be you may that's a distinction from how long do you plan to live in it, right? Because you might say, oh, I lived in it for a while, but it's a good rental property, so I still own it, right? And I'm renting it out, and so that, just a little distinction there. But 5 to 10 years, but 7 oftentimes is kind of that break-even point where we see it. It's very expensive to buy and sell a home. I always like to say that there are a lot of mouths that are fed in that process of buying and selling a home, right? From the lender to the home inspector to the title company to you ever look at those summaries on a transaction. There's a lot of line items there.
Sales commissions, transfer taxes, the list goes on.
Yep. And so I know FOMO can be hard, right? And it is important to not get caught up in the fear of missing out, right? So anybody not familiar with that acronym, right? The fear of missing out, because in 2021 we saw housing prices, spike, especially in this area, right? And we're gonna, show some really interesting stats on that. And we're going to talk about rising interest rates. I know folks are kind of afraid, God, I need to buy something now. I need to get that mortgage now before interest rates go up. All important variables, no doubt about it, right? But it's always good to take a step back and make sure, first and foremost, that your financial house is in order, right? Before you buy that first home, buy that second home, buy that vacation house, whatever it may be. Don't sort of let that fear of missing out, the fear of rates rising, push you into something that maybe you're not quite ready yet for. So Natalie and our team has done a great job helping us put together some really cool kind of recent stats around housing and prices. These are essentially 2021 figures that we're looking at, right? Sort of year over year from December 2020 to December 2021. This is just sort of the national average year over year percent change in home prices. The darker the shade, the higher the year over year increase, and it kind of jumps out you probably already noticed it, right? The Southeast and the Mountain West regions seem to have the higher, but kind of interesting and perhaps not shocking. Everywhere, every single state and DC had year-over-year increase, right? There was nowhere where there was a decrease in housing costs last year. And here's sort of the breakdown, right? You see a lot of, Mountain West and Southeast states were kind of leading the charge in percentage-wise. I know Alp and I've commented that these percentage increases are kind of the outlier, right? This isn't normal to see, 20 to 30%. Year-over-year increases in home prices. 2021 was a little bit of an unusual year and there were a lot of factors playing into that. We'll talk about some of those.
I would say one of the main things that drove prices in 2021, and it's actually been driving it for the last few years, is I'll just call absolutely historical lows on interest rates, which just make it a lot more affordable for somebody to buy a house, and people tend to basically buy what they can afford. So if the payment's gone down, they'll bid up on the house.
Yep. Yeah. I mean, there's a direct correlation between low interest rates and what folks are sort of willing to bid for a house, right? And talk about the bidding wars, and because most people just are hyper focused on that payment, right? And if they think, oh, I can afford that payment, then they think they can afford the house, right? And obviously, affording the payment is essential. But I again, sort of a cautionary tale is, right, that's not the only thing, right? It's still also about, is this a good house, right? Is this something that I anticipate owning for at least 7 years, right? Is this house gonna cost a lot in maintenance and repairs, and the old adage of real estate, right? Location, and right? Is this a location that's just sort of in gone up in price, but not really justified, right? Just because that fear of missing out and everything's going up, right? But could it be the first area to sort of be hit, right? And so this is kind of a frightening 2 words for 2021. I know a lot of folks have gotten caught up in bidding wars on houses.
Especially people helping their kids buy houses because they're worried their kids will never be able to afford a house, and they've kind of made the problem even worse by throwing in larger down payments and just bidding up on the prices.
Mm-hmm. Yeah, we've seen a lot of the waiving the home inspection, right? And it's definitely been a seller's market this past year. And again, I know buying a house is really important and really really great, but I think what you're going to see here on a few slides, that at least things have started to cool off a little bit off of the craziness last year. So I find these really interesting, and just going to kind of focus first up in there in the upper left hand corner, right? So DC median listing home price, you'll see the solid red line was the median listing price last year, and then the blue dot was the median sale price, right? So you'll see that essentially, right, there were bidding wars, all right, and you saw a couple really big spikes up in 2021. Towards the end of the year, you see that coming down and getting a little bit closer. If you look there, a couple other examples, in Chicago, Sarasota, Florida, didn't have kind of that same level, right? That more of the traditional, I'll say, quote unquote, where the sale price was a little bit below the listing price. But DC and San Francisco, right, not shockingly, had some serious bidding wars. But you see that kind of coming back down to a little bit more of a reasonable, level of, narrowing that delta between the two figures.
I know in San Fran, we've heard it from people that have moved out to work with, they'll call it the Googles of the world. And when they go near Silicon Valley, they just at times just throw their hands up if they're looking at properties saying that, I can't believe that just sold for $2 million. And it was like,
not much of a house.
Yeah. Pretty much a shack, right? And it's just crazy. So, but I think we're seeing some of that reverse a little bit. We've talked to local realtors and they've told us that they're still seeing on a hot property, a nice property, multiple bids, but they're not seeing as many 10 or 15 and 20 bids on one property.
Just a few interesting stats as we move along here. I think one of the biggest contributing factors here is, right, not only has there been a lot of demand, right, a lot of folks wanting to buy homes, but you combine that with the supply, right, low levels of inventory, historically low levels of inventory. And kind of tie this back to an earlier comment a little bit too, right? The single family home inventory is particularly low, right? And so you simple supply and demand, you see a lot of bidding wars there. Whereas the supply of those kind of one bedroom condos aren't as low, right? And there's more. You look around DC and inside the Beltway, there are more and more of those condo buildings just getting built everywhere, right? So again, to the point of that, maybe not the starter home, especially if it's one of those smaller condos, because there's a lot of those. There's very little sort of appreciation potential, but definitely historic low levels of inventory.
And I notice it just when you drive around neighborhoods, you just don't see that many for sale signs.
Yep.
And if they're out there, you see the under contract sign almost immediately. And at times something gets sold almost like on a pre-sale.
Yep.
So it's just insane right now still.
Yeah, I've seen homes where the first time they're putting the sign up is to put up the under contract. So I was like, why bother? So we talked about this right here's kind of some interesting numbers. Look, some top 10 cities around the country for rent, right? These are just one bedroom median rent prices. You see DC right there kind of in the middle. So some of the most expensive areas, and here's where it can be a little painful, and I think it also drives the interest in wanting to buy a home, right? You say, wow, the rents are too darn high. And they've been going up. I know, as somebody who's been a landlord in DC, the pandemic in 2020, rents were hit hard, right? People were fleeing the city, and no one wanted to rent a house, especially if it meant, right, like sort of bringing roommates together into an apartment, right? So the rents really fell off a cliff, but they've been, coming back with strong this past year.
I know what's really interesting about the rent prices is I think when I graduated college in the 80s, I'm dating myself, but it was amazing. I was renting one room out of a house. I think 4 guys got together and rented a 4-bedroom house, and one room actually cost the equivalent of what my dad's mortgage payment was. And right now we're seeing the same thing today. People that have refinanced their homes to ultra low rates have got really low payments, and they're telling us that their kids have moved to San Fran, Boston, New York, some of the big cities, and they're paying more for a 1-bedroom than they're paying in a mortgage payment.
Yep.
So full cycle there.
Yeah, not shocking, right? Look at some of these numbers, right? For a 1-bedroom rent, and here's just sort of percent increases for 1 and 2-bedroom rents. This is just kind of the national average, right? So you see it sort of coming out of, I'll put in quotes, out of the pandemic, right? As folks were getting a little bit more comfortable, to get sort of, a lot of folks moving back out, from home, parents' homes or temporary kinds of places. This is all contributing to the inflation, right? That we're experiencing, kind of the topic of the day. And one more just kind of interesting stat, just sort of the percentage of home ownership rates in the U.S. going back to 1990. You see it sort of, within a band of about 64 to 69%. You see a strong kind of run up in the 90s, kind of peaked out early 2000s, was already sort of on decline, but then really dropped off with the financial crisis. And then we had been on a strong kind of home ownership recovery coming out of the financial crisis, and then obvious dip in 2020. But I think we're gonna, if I were to make a projection, I think we're probably gonna see, barring some other surprises, we're gonna see this kind of start ticking back up.
And I'll throw out, like, one of the things Jason mentioned, the dip during the financial crisis. There's actually a theory that we substantially underbuilt for the past 10 years. And a lot of it was stemmed to the financial crisis, where just the developers were not doing mass developments, or just not enough of them. And, we're now paying that price right now.
Yep. Trying to get caught up in essence. So again, we've sort of talked about this a little bit, that, can housing costs go down? Housing prices, they can and do go down, right? And again, a lot of that is, that old adage, location, right? So if you're buying something that's not necessarily the most desirable location, well, that's kind of the high risk of if the next time we go through a recession, right? Those areas get hit first, and home values don't always go up. And so I'm going to come back to my earlier point of, obviously you got to be able to afford the payment, right? And you need to feel comfortable about the payment, and you got flexibility with the payment, but that's not anything and everything, right? Because if the value of the house goes down and you need to sell, or your job transfers you somewhere else, or something comes up where it's time to move, well, shoot, you needed to also sort of take into account, what was the price I paid, what was the potential for that value of that home to move, because they can and do go down. I know Alp has shared stories in the past of doing taxes. Sorry to bring up a tough subject there, Alp, but
Sure, but yeah, there's so many times when I did taxes that there's a form you fill out on your tax return when you sell your principal residence. It's Form 2119, sale or exchange of principal residence, and you actually list what you paid for it, and you list what I'll call your tax basis, which is what you paid for it, plus the improvements you've done to it over the years, improvements, not repairs, and then you compare it to the sales price, and you potentially can have a taxable gain or a taxable loss. There's rules to get out of some of the gains, but there's many times where I've seen people, this happened, I think in 90s when there was a big drop off in housing prices. People might have paid in the late 80s $600,000-$700,000 for a home, and then 7, 8, 9 years later they sold it for $480,000, $490,000, $500,000. Absolutely got crushed on it. I'll say it's very similar to the stock market. You can have periods, and we're experiencing some right now, where the prices go down, but most people don't think that when you go through this prolonged period of stocks going up and housing prices going up, but you can lose money.
Yeah, and directly tied to, if interest rates, right, and the cost of borrowing and the affordability of houses, right, if all that goes up, that will, slow down the pace of increase, in terms of home values, and can possibly even push them downward, right? And again, we've seen, across all decades, I'll say, times where folks have bought a condo, the smaller 1-bedroom condo, and tried to sell it 5, 10, 15, 20 years later, and there's been no appreciation in the value in some of those smaller units.
Depreciation.
Or
plus the selling expenses to get out of it.
Yep.
It's always fun if you, a cool feature of Zillow and some of those programs is they will have the price history of a property, and you can specifically look at 1-bedroom condos in certain areas. And today, maybe they're selling for a profit over what somebody paid for it. But I'd say about 2 years ago, I was actually looking at it and was shocked at just Bethesda properties, 1-bedroom condos, because I was comparing it to some of the newer buildings where the prices are a lot higher. And I was just comparing it to the older buildings. And I was like, oh, look, this building was built in the year 1990. And in 2020, they're selling them for less than what they were purchased for. So, fascinating. Neat part of Zillow.
Something else that we've kind of found fascinating is sort of this phenomena of remote work, and how that kind of relates to housing decisions. And because it's not surprising, right? A lot of folks, when they retire, they might relocate, right? They might say, what, lived in DC or the surrounding area while I was working, and now I'm gonna move to some place, slower pace, lower cost in retirement. And that's been very common over the years. But what's kind of interesting now is we're seeing some folks sort of accelerate that move before they're officially retired, with the frequency now of folks being able to work remote, right? And so I know I have some close friends who are in a similar situation. They're probably about 10 years out from retirement. They had always planned to kind of move back closer to where they grew up in the Ohio, Michigan areas when they retire, but they know that, hey, they're going to work remote the rest of their career. So they accelerated it. They just recently sold their house here in DC, bought a house, half the price, twice as big in Ohio, and kind of accelerated that both career, retirement, housing decision, and find that kind of fascinating.
On the funny side, on the 401k side of our business, we've been in investment committee meetings where people have actually told us, oh, we just found out that 5 of our employees have actually relocated, never really told us. So they have actually seen this happen where people were just banking on the fact that they're going to be able to work remotely.
Yeah. Oh, by the way, I'm not going to be coming into the office anymore.
All right. So generally 3 types of properties when you are looking to purchase condos. And in condos, and I throw out the term condo, I'm also throwing in co-ops, and the difference between condos and co-ops is condos, you own your individual unit. In a co-op, it's basically the whole building's owned by the co-op, and you're actually being asked to join as part of the co-op. You still have to buy into it, but you have to actually go through a co-op board, and that can be a pain in the rear at times. You don't really see it that much in new developments, but in some of the older cities, especially New York City, you'll see a lot of co-op boards. But condos, we've talked about them a lot already. One thing that you have to factor in when you're purchasing a condo is the condo fee. And sometimes condo fees get a bad rap. People think, oh, it's $1,200 a month, and it could be higher. But keep in mind, the condo takes care of everything outside of your unit. So you don't have to paint the building. You don't have to do any of the grounds work, landscaping. You don't have to worry about any of the carpet inside the hallways. You don't have to worry about the elevators, etc. All that's taken care of. It could also cover gyms, other meeting rooms, etc. So you have to really dig deep on it and see if the condo fee is reasonable when you factor in you're not going to pay those other expenses. When it comes to townhouses have homeowners association fees. A lot of them cover your exterior expenses, but not all of them. So it varies by development. So you want to find out what you actually are responsible for when you're buying into a townhouse development. As I said, it will vary by it. One thing I forgot to mention on the condos, one thing that you can actually get hit with, and it doesn't happen that frequently, but it does happen, and that generally means they didn't do a good job with the condo fee building reserves for larger expenses, or it could mean that something happened to the building structure wise that they just didn't anticipate was going to happen that was abnormal. And so they could say, in addition to your condo fee, you have to pay a one-time special assessment, and it could be substantial. We've seen special assessments as high as $15,000, $20,000 if it was a major repair that needed to be done. Houses, obviously best for families, but the big difference between a house and a townhouse and a condo is you're responsible for everything on the inside and outside of the property. You also could have homeowner association fees there, but they vary. Sometimes they're really, really small because you're essentially just paying for a few beautification like annual charges, like if they put flowers near the entrance to the community, things like that. Others, if there's a community pool, if there's a gym, if there's meeting rooms, even in some of the newer developments, you'll pay a higher homeowner association fee. So the biggest question we always get asked is how much can I afford? And so I would tell you, our thing we've kind of expressed already, we're not big fans of people overextending themselves. So we generally try to encourage people to be on the more conservative side when it comes to purchasing a house. We don't want somebody to wipe out all of their cash reserves for the down payment and left with a just very low bank account. And as I mentioned, you actually could be in a situation where you bought the house and in 2 months you've got a major repair. But great example of like,
I had a question on, should somebody consider tapping their 401k?
Personally, not a big fan of that. For purchasing a property, you can actually pull money out of a 401k. I think IRAs and 401ks, I think they made the same thing for 401ks. I think you can pull $10,000 out and not have to pay an IRS penalty. I know that's true on the IRAs. On the 401ks, I'm going to say consult with your tax advisor. But we're generally not big fans of seeing people either borrow or pull out of their 401ks. We think you're better off saving up for it and then only using the 401k, I'll call it, if it's an emergency situation. In terms of what you can afford, we thought one of the easiest ways to show you what it costs to own a home is just how much will a mortgage be? And so the example we have here is a 30-year mortgage, $500,000. We're showing you 3.75%. Probably about 3 or 4 months ago, you could get around 2.75% on a 30-year mortgage, and you probably get about 2%, 2.25% on a 15-year mortgage. But $500,000 mortgage, $2,315.88 a month. And this is what's called your principal and interest payment. So that's repaying the $500,000. If you make your payment for 30 years, it's paid off. You own the home. But in addition to that, you actually have to pay real estate taxes and homeowners insurance. And those are usually added to your payment. So if your real estate taxes for the house are $10,000 a year, that means you'll have another $833 a month added to your principal and interest payments. If insurance is $1,200 a year, that would be another $100 a month added to your payment. So all that typically goes into escrow. However, you can actually buy a house and not have the taxes and insurance go into escrow and just pay those payments directly yourself. You'll be responsible to pay it whenever the bills are due. On a $1 million mortgage, you're talking about $4,774. And you'll notice we used a higher rate. Typically, the larger the loan, and there's conforming and non-conforming jumbo, but they will charge you a tiny bit more on the mortgages when they're above the conforming levels, and it varies by regions in the country. But typically, conforming loans are going to be under 575,000 or so. But just look at it for locally. It's a really easy Google search.
Yeah,
Go on.
jurisdiction sets its level, but they're all pretty similar.
Not all the mortgage is tax deductible. Jason, I'll say potentially not all the mortgage is tax deductible. So if you borrow $1 million on a house that you purchased after 2018, they put in new limits with the tax law change in 2018. You're capped at $750,000 of, I'll call it, loan balance that you can write the interest off of. So if you have $1 million mortgage, basically 25% of your interest payment, 25% of it will not be tax deductible. And it's actually pretty simple to calculate. There's formulas that do it. If you owned a home prior to 2018, that limit was $1 million. And actually there's a way to get it to 1.1 million if you had a home equity loan. But again, great way to look at what you can afford and factor in addition to the principal and interest, the taxes, the insurance, and in a little bit, we'll get to the maintenance expenses. You have to factor that in as well. Debt to income ratio and why it matters. We're big fans of trying to keep your payment to about 28% or less of your gross monthly income. And you'll see if somebody's got a really clean balance sheet, the lenders will let you go substantially above that. When I say clean balance sheet, you've got no student loans, you've got no credit card bills, or I'll call it, you could have credit card bills, but you don't have any credit card debt that you're carrying from month to month, and you might not have any car loans. But they will look at the debt to income ratio, and they're obviously just trying to qualify the loan to make sure they're giving out good loans. And I'll say after the credit crisis, they've been much stricter on these limits, and I'll say much stricter at looking at somebody's credit score, which Jason mentioned earlier. But you can go above that 28%. We'll see some people go 35, 40%, but we prefer that you try to keep it around this level because we want you, as Jason mentioned earlier, we want you to continue to hopefully fully fund your 401k. And if you've got kids, you want to make sure you're saving for college. So we don't want you to get overloaded on the house. Frequently in our business, if we're given a seminar somewhere and just talking to a live audience, and so we'll come across people that have basically got in over their heads on their homes, and they wake up 15, 20 years later and they realize they've saved very little for retirement and maybe zero for college expenses. So it's really important to factor it all in. Home loans, a lot of different types. Typically on a first home purchase, most people go with 30-year loans, and most people go with 30-year loans on properties to begin with. However, in a lower interest rate world, if we have a high income person or high income family, and since interest rates are now lower for 15-year loans versus 30-year loans, we think it makes sense to look at a 15-year loan. And the big difference is exactly what it sounds like. If you get a 15-year loan, you're going to pay it off in 15 years. And I know we've had a lot of our higher income clientele over the last 5 or 6 years take advantage of the shorter loans and look at it as like, oh, if I could have my house paid off when I'm 50, 55 years old, they just think they're in much better shape for retirement.
If you ever look at those amortization tables, the total amount of interest you save over the life of the loan is huge.
Yeah, so I'll throw out, we see family loans a lot. We'll see parents loan money to their kids, and there's ways that they actually can loan it for below what I'll call the normal market rates are. And there's formulas for how that works. And we also see adjustable rate mortgages, but that's rare. We saw a lot of it prior to the housing crisis, credit crisis in 2007 and 8. Basically, the big difference with adjustable rate mortgages is the rate is just locked in for a short period of time. So you could have a 3-year lock-in period, a 5-year lock-in period, 7-year lock-in period, and then the rate will become a variable rate and it will fluctuate for the duration of the loan. And that caused a lot of problems during the credit crisis. I'll say today, we're seeing a tiny bit of it resurface because rates have spiked up, and especially if somebody said, I've lived in my house already for 20 years, I'm refinancing, but I'm confident we're going to be moving soon because we're going to be retiring in 5 years, and you'll see people go with a shorter term loan in that example.
On an earlier slide, we referenced a website, and if you notice, bankrate.com, really great site for comparing home loans. Rates and different lenders. I'll also just mention, when you are comparing loans, if you're kind of shopping around, just a quick tip is, have them quote the rates with no points. So that way you're comparing apples to apples. And then you can always sort of layer on, okay, what if I did pay points to buy the rate down? What would it look like? But just when you're in that comparison stage, just say, hey, show me everything with no points so you can easily compare.
So in this hot real estate market we've been in, these terms are very relevant. And pre-qualified basically means that prior to searching for a home, you basically get an informal agreement that, yes, you can actually qualify for this amount of a loan, and they'll send you a letter saying you're pre-qualified. On the other hand, pre-approved, it's a formal commitment from the lender. They've actually done a decent amount of underwriting on you. A lot different. However, I'll say even on pre-approved loans, we've seen things fall apart if things were discovered after the fact, or if just things change for whatever reason. On the pre-qualification, again, a lot can change. One of the things we always tell people whenever they're going through a home purchase, and if you're going to be financing the property, we want you to always stay on top of the loan process. And what I mean by that is, even if you've given the lender everything they're asking for, I'm a big believer that you want to ask them literally on a 3 or 4 times a week basis. Maybe I'm stretching on 3 or 4 times, but you constantly ask them if they need any additional information.
Yeah. And any seller in this particular market they're not even going to be interested in an offer from somebody who's only pre-qualified, right? They're going to say, you got to show us proof that you're pre-approved.
Or you're gonna have to bid a lot more.
Or you're gonna have to bid a lot more, yep.
For them to take on that risk that it could fall apart on them. Mortgage rate lock, I know we got a question on that earlier. And the question was like, how do you assess the current situation? Should you float the loan or lock it in? And what we mean by floating the loan is, you put the down payment on the house, or you put the deposit on the house, you're going through the underwriting process. You could either lock in a rate or you can float it, which means that you'll have to lock it in later on. And if you're floating it, the rate can go up or down. And so there's a little bit of luck involved. In this current environment right now, I'd say we're just big fans of locking it in, especially if you believe that you're kind of pushing the limit. I know we've told you we don't like when people push the limit, but if you are pushing the budget a little bit, I'd rather not have any future surprises and have rates go up, because the amount that they went up recently can definitely hurt some of the first-time home buyers. And one of the lines that we always use is rates tend to spike up and trickle down. So it'll go up very quickly and then take its sweet time on its way down. So big fan of just locking in that rate. Little quick talk on just unmarried couples buying homes. We see this frequently. Nothing wrong with it. We're just big fans of having an agreement in place in the event something happens to the relationship, because we see it over and over again. One person might have put in the down payment. One person might be paying more of the payment, but then something happens to the relationship and they're trying to figure out, well, who's going to take over the house? And there might be a disagreement on, well, you never told me that the down payment, even though you paid it all, I can't share in that now when we sell the house. So it's great to have an agreement in place.
Yeah, yep. Just simple outline, right? Down payment, who's making the monthly mortgage payment, maintenance costs, right? Just kind of outlining that, and the relationship, right? We've seen it where it's friends who go together, right? Doesn't necessarily have to be, boyfriend, girlfriend, partner, that sort of thing. But anytime, right? Folks are going together on the purchase. It's good to have that kind of just outlined so there's clarity when some questions arise in the future.
And they will arise.
And they will.
Sources for down payment. We've got personal savings, gifts, sale of assets, retirement plan. We've already talked about the retirement plan one. Gifting is one that we see frequently amongst our client base if they're helping their kids out to buy a property. And so the lenders will look at your deposits into your bank account. They're going to ask for your statements. And if they see a large deposit in there that you can't verify that it came from the sale of an asset that you own, or it came from a bonus, you actually then have to tell them, oh, I got either a loan from a family member or a gift. Now, if it's a gift, they're going to want to see a letter saying it is a gift from the family member to you, and it does not need to be paid back, because they're trying to underwrite a loan. They don't want any surprises. They don't want you to be liable for the debt of the loan that they're giving you, plus another debt if somebody gave you the money for a down payment. So they go through a protocol there. Personal savings, very straightforward. If you've saved up, we've mentioned this, we're not big believers of wiping out all of your personal savings. We like everybody to have their cash comfort zone. If you're selling an asset, if you're selling that, I'll say that Apple stock where people have made a lot of money over the past decade to put down on the house, keep in mind you'll also have capital gains exposure. So if you sell $50,000 of stock, you're going to owe taxes on that if you're selling stock with a gain. When it comes to closing costs, there's always a lot. And the neat thing is right now, a good realtor will be able to give you a really good summary of what to expect on a certain price house. And actually, once you put a deposit on the house, you can immediately go to your lender and ask them for what they think the anticipated closing costs are going to be. And sometimes they'll have truth in lender disclosure statements. You can get, early copies of that. But there's a lot of things that go into it. So originally when you're buying a house, you give them a deposit on the house, and your down payment is over and above the deposit. So if you're buying a $500,000 house and you gave them, $15,000 of just a deposit, and if you're going to put 20% down, you're now going to have to come up with that $85,000. So that will be part of the closing cost. You're going to have appraisal fees. I'll call it just things that go into escrow, settlement fees, transfer taxes, title insurance. And when I talk about escrow, if you buy a property, let's just say you buy a property in Montgomery County on September 1st. Montgomery County real estate taxes are due on September 30th. And so they will build up a very large amount into your escrow, because you're going to have to pay that
Right
out
away.
almost immediately. So you'll see that as a closing cost, and they can all add up. And if you don't put a large down payment on, you're probably going to have something called principal mortgage insurance, or PMI. So that at times is a lump sum, and it's just billed on your settlement statement.
Yep. Typically, that threshold is if you have 20%, of equity. You can avoid that.
Home expenses. I like focusing on the 1% rule up top, and this is probably most applicable to, I'll call, personal resident homes as opposed to townhouses and condos, but it's going to cost a lot on any property because things do need maintenance. But homes, typically you could easily factor in 1% of the value of your home for home maintenance, and it's not going to be every year. I've had years with my house that virtually nothing broke down, and maybe we didn't spend that much on landscaping, didn't do any landscaping improvements. But then there's other years that, oh, the heat pump went out, or the HVAC went out, or a major appliance broke down and it
Replace the
wasn't worth.
roof. Yeah.
It can just add up. But just think of the things that you're going to pay just on an annual basis. You're going to now have, if you've gone from renting, you now have taxes, and we've talked about that. Likely that'll be put into your payment. If it's a condo, you have your condo fees, you'll have utility bills, you're gonna have just maintenance fees. And I'll just say, if you've got a big yard maintenance, and if you're not the type of person that likes doing it themselves, that can be really expensive these days. So, and this is all separate from what I'll call just renovation. So if you're buying an older house and you're gonna have to renovate certain things down the road, that cost is expensive, and you want to make sure you reserve enough for that in the future. Can you negotiate? Very difficult right
In
now,
this current market.
without a doubt. I'm going to say in normal markets, you can always negotiate. And one of the easiest ways to know if a property is like a hot property is you can usually, when you go on to the listing, you can see how long it's been on the market. They'll call it days on market. And so if you see the property's been on the market for 30 days, 100 days, 150 days, they're not getting anywhere near the offers they want on the property. And so to me, if you give them a full price offer, you've probably paid too much. And a great way to find out if you've overpaid for the property is just remember this: if they accept your first offer, then you likely have bid too much. So, at times you will get some pushback from realtors that will say, well, you know what? I don't want to bring this offer to the seller because it's an embarrassing low offer. I mean, it's their responsibility to bring any offer to them. So if you think the asking price is way too high and you can support your case, don't be afraid to go below it, especially if you see that the property's been sitting on the market for a while. So you can negotiate, but fairly difficult in today's market. Escalation clauses. So that's something that we see a lot today, and especially with the bidding wars. And what that means is, with your offer, if it's a hot property, and the realtors generally know if they're going to receive multiple offers on the property. And so they will work with you to basically put in what's called an escalation clause. So if you're buying a $500,000 house, they'll say, we think it's going to get 5 or 10 offers on it. So we think it's probably going to sell for closer to 550, but we're not certain where it's going to be between 500 and 550. So they will work with you to construct an escalation clause. And so let's say you bid 510 for the property because you think it's going to go over 5 and you want to come in with a strong offer. You can actually put an escalation clause in that says, I will go up, and you can make it up however you want, $2,500 above the highest offer. And you would put a cap on it. So if you put a cap on it 550, that's the most you would pay for the house. But keep in mind, if the realtors get 2 or 3 people to put escalation clauses in, it's automatically going to kick up to whatever your limit is if everybody's at like that 550 limit. So, and we've seen some escalation clauses go awry where somebody put in a $200,000 escalation clause on $1 million house, and it shot up to
It got there.
1.2.
Yeah.
And you have to remember, if that happens, if you were only putting, I'll call it 20% down, you had reserved for $200,000 down. Now your lender is going to ask for 20% down on 1.2 million. So you have to come up with more money. So be careful with that. So when should refinance? We get a lot of questions on that. Obviously, on a temporary basis, it's gotten more difficult because rates have gone up. I would tell you, I'm a big fan of looking at what Jason mentioned earlier, bankrate.com. Just compare your current rate to what rates are out there right now. We're big fans of 0-point loans. I know people talk about, should I pay a point? I think we've been in this long cycle of interest rates going down and down and down. I've felt in the past that if you've paid points, you've generally wasted the money because there was another opportunity down the road to actually get a lower rate. So I'd rather just go with a 0-point loan. And one of the neat features with loans today, they've become a lot more, I'll call it financially, I'll say easy to adjust. And what I mean by that is you can actually say, I want a 0 closing cost loan on a refinance. And let's say your loan balance is $400,000. You can say, I want to refinance for $400,000 exactly what my current balance is, but I don't want to pay any closing cost. And so they will factor that into the loan rate. So if the current rate is 3.75, they'll say, if we charge you 4%, we'll give you enough of a closing cost credit to wipe out all of your closing cost. So if you can get a lower rate in that example, so if you're currently paying, 4.5% and you can come in at 4% with all the cost, then I think it's worth refinancing. Again, just have to look at it and decide what you want to do. I will say one of the drawbacks of refinancing a lot is you could end up being in a situation where, if you've refinanced multiple times, you could have a 30-year loan on a house you bought 20 years ago. So something to think about.
And we did have a question around another kind of evolution in loans, something called recasting, and I think these are some pretty cool new features. I'll call them new. They've probably been around 5 to 7 or so years now, but in essence, you may not have to go through a full refinancing, right? And where this typically comes into play is if you want to make a big payment, right, to pay down the mortgage balance, and say, you know what, I want to put a $25,000 payment, $50,000 payment to pay down the mortgage payment or the mortgage balance. In the past, when you did that, your monthly payment stayed the same. Okay, even though the balance went down and your total interest paid is going to be less, but the monthly payment stayed the same because the amortization table stayed the same. With recasting, it allows you to make that big lump sum payment, and then they recalculate and re-amortize the loan, and it will reduce your payment. And so if you're looking at getting a new loan, just confirm. Most of them, I think it's kind of become standard, but just confirm, make sure that it has the ability to recast. Sometimes they might limit the number of recasts that you're allowed to do over the life of the loan. And then typically what we're seeing these days is they might just charge you sort of a nominal kind of administrative fee to do it, $250 to $500, right? Which is typically a lot less than going through a full refinancing.
So purchasing a second home. So if you think about the different types of second homes, you could have a rental property, personal use property, and then I'll throw in a combination, which is what we usually would say vacation homes, which are generally beach homes where you could actually rent it for 6 or 8 weeks a year and then use it for personal use the rest of the time. But if it's personal use, Jason mentioned this a little bit earlier, you're basically going to have the identical expenses with your current residence, right? So if you have cable TV, you're going to have 2 cable TV bills, you're going to have 2 sets of utility bills, 2 sets of yard maintenance, right? So all that stays the same. So it's generally, it's a big expense. I personally own a recreational use second home and I like it. But I would just make sure that if somebody's going to go down that route, that they feel really comfortable with their finances, so they're not stretching their budget to buy the second home. Rental homes are very straightforward. Basically, it's a business, so you could, and Jason's had rentals in the past, but essentially you take all the rent in and you write off all the expenses for maintaining the house. So the mortgage payment, the real estate taxes, repairs that you're responsible for that you didn't pass on to the tenant. It really is a business. You just add up all the expenses and you deduct them from the rent, but there are limits on being able to write off what we call rental property losses. And I'm going to say, talk to your tax advisor. It is too complicated to explain it. And if you buy that vacation home, as I said, that's that combination of personal use and rental use. There are special rules there on how you write off things like your mortgage interest, real estate taxes, and repairs. It'll have a pro rata formula according to that, according to how much you used it personally versus how much you rented it. If you buy it as a beach property that you're going to pretty much rent it for the entire season, and the rest of the period you actually are, I'll say, repairing the property, then you can pretty much treat it as I'll call it a beach house rental and write off all the interest and real estate taxes on it. When it comes to purchasing a second personal use property, I mentioned earlier that you're capped on mortgage loans at $750,000. That unfortunately is not per property. So if you own a primary residence with I'll call it a $600,000 loan, and you're buying a beach property and you've got a $500,000 loan on that, Unfortunately, if it's personal use, you're only going to write off $150,000 of the loan, of the interest expense on $150,000 of the loan. So a little bit of a headache.
Mhm. Well, wrapping it up here, thank you, Alp, and everybody for joining us. So a couple last comments here. Building your team, right? We talked about all the mouths that are fed in the process of buying and selling homes, but obviously you're gonna need a team, right, in this process. And realtor, appraiser, insurance agent, a home inspector. If you have a friend who's a contractor, right, maybe they can come walk it through. So because I know we talked about in this current market, a lot of times you have to, the sellers want you to waive the home inspection, which can be a little nerve-wracking to do that. Title officer, mortgage professional, and I'll just comment sort of around, especially when it comes to the realtor and mortgage professional. We probably all have a friend in the business, and you might feel a sense of loyalty and want to work with your friend. But if they're kind of new to the business, just I would say, make sure you're working with somebody who's knowledgeable, knows the current market, knows how to maneuver the process, work in your best interest. Because it's a big transaction, and you want to make sure that you're taking it serious.
Generally, the largest financial transaction of one's life is buying and selling homes. And one thing to point out, especially for the first-time home buyers, if you're signing on with a realtor, typically the realtor, not typically, but their fiduciary responsibility is to the seller unless you engage them as a buyer's representative. So it's important, if you really want somebody to be negotiating on your behalf, you want to sign them on as a buyer's agent.
They're representing you. Yep. Just especially for first-time home buyers, to Tom's point, this is a great resource. Another good organization to check out. And I know we've run over a little bit here, but thanks for joining us. So our next two upcoming workshops on March 31st going to cover long-term care insurance, long-term care, and including long-term care insurance. And April 28th, as I used this term earlier, making work optional, living your retirement dream. So hopefully you can join us for those upcoming workshops. As I mentioned earlier, please don't hesitate to reach out. If you're listening to the recording, you can also reach out to our team. Happy to answer any questions related to today's workshop or anything else. So thanks again, everyone. Stay safe. Enjoy. I think it's going to be a beautiful weekend this weekend. So
perfect.
All right. Take care, everyone.
Take care. Bye.